write down the correct or the best letter, A, B, C, D, E. Okay, so 50 questions covering chapters 1 through 10. We're going to review tonight, and I don't think that I'm going to say a lot of extra stuff tonight, so this would probably, if you haven't listened so far, this is probably the night when I'll listen. Okay, any questions on that? Okay. We're going to talk about some things, and I'll ask you some questions, and we'll just see if we can come up with some answers. You all did a lot of, on your interviews, you talked to different agents, and we learned that there were independent agents and captive agents. Do you know what the difference is? What's an independent agent mean? Anybody remember? Or the opposite of that, what's a captive agent? That would be like State Farm or Farmers Insurance. Anybody remember?
Independent doesn't work for one company necessarily.
Yeah. A captive agent means I'm working for State Farm, so that's I still sell State Farm insurance. Where an independent maybe sells from 5 or 6 different companies. We talked about Blue Cross Blue Shield, and they were started years ago. Blue Cross was they would pay your doctor bills. Blue Shield would pay your hospital bills. Now it's all one company. Blue Cross Blue Shield, they're all across the country. They were started as nonprofit, and largely they are, but they're not all nonprofit. Blue Cross of Kansas, just a mile or so away from here, is that nonprofit, but they are not all. Some of them are affiliated with for-profit companies. We talked a little bit about when an agent sells you something, there's a concept called apparent authority. They have an apparent authority. Does anybody remember what that means, or can you kind of think about it? If I'm an agent and I sell you a life insurance policy and I have apparent authority, what do you think that means? Any guesses?
So like if something happens, say like your dishwasher breaks and it burns down your house, the insurance company will give you the money to repay your house, but you give up the right to sue the dishwasher or whatever caused the damage. Is that it?
No, but I like where you're going there. It's basically, in a way, it could kind of be connected to that, but an agent is telling you stuff because he or she is the authority. So you have a right, as somebody purchasing, to assume that they have the authority to sell you the product and to tell you how it would work, like in the case that you just described. So you can't just say anything about it. Well, he told me that I wouldn't have to pay for 6 months, and so I didn't. Then you canceled my policy. Nobody's going to believe that. But if you have some reasonable proof that the agent told you this, you have a certain amount of, it's certainly reasonable for a court or an arbitrator to decide that they had apparent authority. So they have the authority. They're the ones selling it. They know about it. I don't. I'm just a customer. So apparent authority. What is it reasonable to think that an agent should be able to tell you? Well, it's reasonable to think they're the authority, and they should be able to what they tell me, it should be pretty good advice. Okay, underwriting. What did we say when we were called underwriting? What is underwriting? In part, remember when we had Nicole, actuary, come talk to you. She's part of the underwriting process in trying to discover, to figure out how much they should charge for policies. How much is it reasonable? By looking at statistics. What else is involved in the underwriting process?
Isn't it like classifying and organizing people into categories to define like what their rates are gonna be?
Good. Organizing, classifying people, pricing, all of that underwriting, getting the policies signed. So let's see, getting out, you know, when I go out, when I get out, when I'm an agent and I want to sell you a product, I'm going to, part of the underwriting is I'm going to take an application and then I'm going to see how much, you know, we may come out and do a blood test on you, we may do your blood pressure, for life insurance policy. If you're buying a homeowner's policy, we want to come out and look at your house, make sure the roof is good. So all of that stuff in determining how much we're going to charge you. So it's all of the stuff prior to us giving you a policy. Okay, and along that lines, we talked about underwriting principles. Underwriting principles are principles that a company wants to follow to be in business. So underwriting principles, we want to make sure that a policy is affordable but not too expensive. Affordable but not too cheap. Why do we not want it to be too cheap?
Because then the company won't be able to like pay the losses when they occur.
Right. And why don't I want it to be real expensive then? That way I'll make a lot of money and I'll have money to pay off. Why don't I want it to be too expensive?
No one's gonna use you.
No one will buy it. Okay, what is an actuary? It's a highly skilled mathematician. We talked about candy bars. We talked about O. Henry bars that were invented in Kansas, in Dexter, Kansas. O. Henry bars. We talked about how do you make a candy bar? How do you price it? Is that different than an insurance policy? Yeah, it is. Because, for one thing, the candy bar, you know what ingredients go into it. It's a set fee. You can buy the sugar, you can buy the chocolate, you can buy all the stuff you need, and then make your candy bar. You know how much it's going to cost to package it, ship it out. It's all fixed costs. And you know what you need to charge in order to make a profit. Where with a auto policy, I never know. I sell you the policy, I promise to sell it to you for 6 months, you promise to pay me for 6 months, and I don't know whether you're gonna have a wreck or not. I hope you don't. I hope nobody has a wreck. So it's different. It's a different product, different. So rate making for insurance policies is different than other products. Everybody remember what a balance sheet is? Talked about a company that, an insurance company have a balance sheet. What does that mean? What's a balance? Assets and what? Liabilities. Balance sheet kind of summarizes that for you. It doesn't tell you everything. If we were going to make a balance sheet for this classroom here, how much detail would we go into? Count maybe how many chairs, each one is worth $20, but you know, we probably wouldn't count how many of these we have. So we'd summarize and say, well, chairs, we have $1,500, and the screen, we got $750. So it's a summary of what you own. It's not necessarily, it's not like a whole inventory. But it summarizes the difference between assets and liabilities. Okay, loss reserves, we talked a lot about that, even though it's not a very memorable name. Reserves, what are reserves for any insurance company? What's a reserve? If I'm a company and the state of Kansas tells me I have to have a certain number of reserves, what are they telling me? Yes?
Like the amount of cash on hand you have in case something goes wrong or you have to bail or something.
Exactly, and over years, a formula's been figured out that is pretty close to being what you need to do. You know, it wasn't always like that. If you were an insurance company, you could sell policies and I didn't have to have any reserves. And if I had lots of claims, I'd just go out of business. Well, we don't want to see that, so we make sure that companies have reserves on hand. Okay, so on a balance sheet for a company, would a loss reserve be an asset or a liability, do you think?
Liability.
Liability. Because it's money you've got set aside, assuming you're going to have to pay it out. So even though you've got $100 million in the bank, if you're a really big insurance company, you got $100 million in the bank, it's not yours. You know that somebody's gonna wreck their car, you know that somebody's house is gonna burn down, so it's a liability. When you wreck your car, generally, an insurance company will look at it, and even before they've settled, whose fault it is, or is each driver 50% at fault? Your insurance company's gonna look at it, and they're gonna make an estimate. It's gonna come out of that loss reserve. They're gonna make an estimate of what that's gonna cost. You wreck your car tonight, tomorrow you go to your insurance agent, he says, take it over to this place, have a look at it. You bring your car over there, they look at it, they're gonna make an estimate right off the bat. It's just an estimate, that's loss reserves, it's part of loss reserve. They're gonna make an estimate on what it's going to cost. So it's gonna come out of that loss reserve money. They're gonna look at your car, and they're gonna say, this is probably gonna cost us $22,500 to get out of this. So they're going to set a loss reserve from the reserves that the company has. So that's what that money is for. We talked about all 50 states have a Department of Insurance. Kansas is a very efficient one, is generally known as doing a pretty good job, doing a real good job. What does an insurance department do? What are they for? Any ideas? They're here to protect consumers. What else? How can they protect consumers? Okay, good. Inform them what companies are good. They maybe wouldn't tell you that just like that, but you'd be able to get some kind of a table that would show what companies are the strongest. And all of that we just talked about loss reserves that they require a company to have. So they're going to make sure that the insurance company is solvent. And we talked about solvent last time. It means that the company is on solid footing. They've got money put away. The Department of Insurance is there to compensate for the consumer's lack of knowledge compared to the company's sophistication. Another way of putting that, you'll hear this if you ever invest, someday when you have a truckload of money and you need to invest, you want to buy some stock of some kind, and maybe you're wanting to buy something that's a little riskier, or you're wanting to buy Bitcoin or something, they will sometimes want to see your balance sheet to prove that you have $1 million sitting around in the bank, that you are a sophisticated investor. Well, most people that buy insurance aren't that sophisticated at buying insurance. So they're unsophisticated, but the company is sophisticated. So the Department of Insurance is protecting the unsophisticated buyer from the sophisticated seller. Okay, so why is it important that an insurance company be solvent? And the answer to that is that they're selling you a policy that's sold into the future. If you go buy a Hershey candy bar tonight, you don't really care that much if Hershey goes out of business tomorrow. You've got the candy bar. You paid $1 for it, you've got the candy bar. Insurance is different. If you've paid for 1 or 3 months of insurance and the company goes out of business, you don't then have coverage. You don't want that to happen. So solvency, meaning how strong the company is and having it, they have enough reserves, they've got money, they've got cash to keep in business, is very important. Okay, we talked, this is early on, I'm sure nobody remembers this, McCarran-Ferguson Act of 1945. The McCarran-Ferguson Act of 1945 was an act of Congress that put the responsibility of regulating insurance on the backs of the states. So if you have a problem with farmers insurance, your auto insurance, you're not going to call Washington, D.C. You're going to call Topeka. And you're going to talk to the Kansas department about something that happened in Kansas. The reason that you can do that is because the federal government, through Congress in 1945, passed the McCarran-Ferguson Act that gave the primary responsibility for the regulation of insurance to the states. So, because of that, every state can do things a little bit differently than other states, but they all do the same kind of things. They allow companies to form in their state. You have to follow the laws of the state. They license insurance agents. So every insurance agent, if you talk to an insurance agent, some of you may not, because we talked about insurance professionals, so they might not be licensed. If you go buy a policy from Farmers Insurance, that person you're buying it from is licensed. They have to get a license through the Department of Insurance. So and then again, Nicole, when she came, she regulated companies by making sure that they were charging consumers fair rates. They also tax insurance. A lot of times you don't realize when you buy an insurance policy, you're paying a tax also. That's also done at the state level. So the key point here is insurance is regulated at the state level, not the federal level. And the reason for that is because of the McCarran-Ferguson Act of 1945. So, do all 50 states have an insurance department? Yeah. Okay, there's an insurance commissioner, some states call it superintendent of insurance. There's somebody that's at the top that runs the Department of Insurance in each state. And they have the ability to hold hearings if they want to take somebody's license away, or if there's some other incident going on in the world of insurance in their state. So they can hold hearings, kind of like a trial, but it's done on a smaller level, each at the Department of Insurance. So the insurance commissioner or the person they designate can hold hearings. They can issue cease and desist orders. What's that? What's a cease and desist order? If I give you a piece of paper and it says, you are to cease and desist, what am I telling you? You are to cease and desist from selling any more life insurance. What's that mean? Can you do it or can you not do it? Not do it. It's a legal term. It's in all kinds of things. If somebody, if I steal, or if I take a photo of somebody famous and then I make a shirt, I might be violating copyright law, but I'm also violating their privacy, what have you. So they may sue me and they get a court order to give me a cease and desist letter telling me that I have to stop selling t-shirts. Same principle in insurance. If you get a letter that says cease and desist, remember when we talked about somebody going to an elderly church and selling, not really selling, but giving away life insurance. Remember that? Stranger-owned life insurance. If a insurance department found out that somebody was doing that, they would likely send them a cease and desist letter saying, you have to stop that right now. And now we're going to take you to court, and we're going to fine you, and we're going to take away your license. But they start many times with a cease and desist order. They can revoke somebody's license, insurance license, or they can suspend it. Okay, risk-based capital, we've talked about it. Risk-based capital, again, it's a requirement that a company has to have a certain amount of insurance, they have to have capital, like cash in the bank, or they have investments, certificates of deposit, stock in very stable investments. Risk-based capital is required by law in every state. Security benefit, I might have mentioned earlier, one of their things that they have invested in, plus some of the other companies associated, is they bought the Dodgers. And that aroused some suspicion by regulators. Why would that arouse suspicion and interest by regulators? Security benefit of the big companies, they buy the Dodgers baseball team. Some of the regulators, states, were concerned about that. Why do you think they'd be concerned about it?
It's volatile.
Yes, it's a baseball team. We like when insurance companies buy a whole lot of IBM stock, or Microsoft, or PepsiCo, or Coca-Cola. So we like stability, because we don't want the valuation to go down and then the company doesn't have money. So why would a baseball team not be as stable, perhaps, as Microsoft stock or Walmart stock?
It's not liquid at all?
That's one problem. You got a baseball team you want to sell. Who's going to buy it? What if there are not any buyers? About the year right after they did that was, a couple of years ago. Remember when the Dodgers won the World Series? Remember that? Anybody follow baseball a lot? So the Dodgers won that about 2 years ago. So the Dodgers in the World Series, and you can see if they had won, that team would be worth a whole lot more than, well, they didn't win. Now, because they made it that far, it was pretty stable, but it's, you know, it's not the same as a real stable stock in some business. So a regulator is gonna be looking at that. What are they investing in? Principle of indemnity. We talked about that. It's a major principle about insurance. What is it? What's the principle of indemnity?
You can't profit off of like your loss.
Okay, good. You can't profit. You're not buying insurance to profit. You don't buy a $5,000 car and then insure it for $100,000 and then hope you go out and wreck it and then you get $100,000. Indemnity, it's all you are going to be able to replace is what the car was worth. So principle of indemnity, it's a major principle in the business of insurance. Otherwise, insurance just becomes like a casino, gambling. I'm gonna buy something, I'm going to pay, insure it, and if I lose it, I'll make a lot of money. What type of insurance doesn't follow that, the principle of indemnity?
Life insurance.
Life insurance, why not?
Because you can't really put a price tag on someone's life.
Can't put a price tag on somebody's life, so it's different. We can figure out how much your Ford Focus is worth, but we can't figure out how much your grandfather was worth. So the principle of indemnity doesn't really work with life insurance. Okay, when they're trying to figure out what they're going to pay you for a car that was totaled in a wreck, one of the ways that they do this is fair market value. How do you figure out what is fair market value, and how do you figure it out?
The cost of the thing you're insuring minus depreciation.
Okay. So how do you figure out how to do that? How do you figure out that a car was worth $7,000?
You see what like other cars that are like the same make and model go for in that area.
Okay. Yeah, you have lots of opportunities with a car. It's really pretty simple because we can look and see what cars are selling for at any given day. And remember, we talked about what a willing seller will sell for and a willing buyer will buy for. If I'm willing to sell you something for $100,000 and you are willing to pay me $10,000, we don't have a fair market value. We don't know what it's worth. I won't sell, you won't buy. But if we both decide that something's worth $12,000, that's fair market value. You're willing to buy it, I'm willing to sell it for that amount. And that has to be like a third-party arm's length requirement there. I mean, it's like when you buy something from your grandma and she sells you her $12,000 car for $2,000 because your granddaughter, that's not the same. That's not a fair market value. Broad evidence rule in trying to determine what something's worth. Broad evidence rule, what's that mean?
All relevant factors an expert would use to value property.
Good. Broad evidence rule, it's used in cases such as, I saw since last weekend, or this past weekend, a Porsche 912, which they quit making in 1976, but it had the serial number for the engine was the serial number for the chassis and the serial number for the body, I think. And they quit making them in the last ones were in 1976. So if find one that I saw that had like 39,000 original miles. So that's a car that is, you know, over 40 years old. It's got less than 1,000 miles per year. So in trying to figure out the value of that, it's gonna be pretty hard because the car sold new for maybe $9,000. So what's it worth 40-some years later when it's in perfect shape? It's pristine. They've kept it in the garage. It's got perfect tires, perfect seats, leather seats, perfect body, perfect everything. 39,000 miles on it. What's that worth? You can't just say, well, you know, a typical 1976 Porsche 912 is worth, which cost $9,000, so now it's worth $4,500. So you're going to have to use broad evidence to come up with that. That got destroyed in a fire. You're going to have to make a determination of what exactly was that worth. It's a collector car. It's never been restored. It didn't need to be restored. It's like, it's in perfect conditions, like the day they drove it off the showroom floor. So an expert would say all of those things. It's like a brand new car. So broad evidence rule. You're allowing evidence to be brought into the discussion to try to determine a value for that car. You may come up with a value of maybe $100,000. So, okay, real quick, risk. What did we say about risk? What is risk? A definition.
Uncertainty concerning the occurrence of a loss.
Okay, uncertainty concerning the occurrence of loss. Peril, what's the word peril mean?
Cause of loss,
Huh?
like a cause of a loss, like a fire,
Okay,
when a house burns down.
cause of a loss. Tornado blew the house away, the peril is tornado. 4 types of hazards. Moral, remember moral? The hazard, moral hazard, somebody's gonna steal from you. Attitudinal, what was that? 4 major type of hazard.
Like carelessness.
Carelessness, good. Left your keys in your car, I don't care. Legal, what's a legal hazard?
Harmful regulation.
Okay, regulation is, you're gonna have to put up with it. If you sell health insurance, you're going to have to sell it to everybody now. You can't refuse anybody anymore since the Affordable Care Act. That's a legal hazard. What that means is you're gonna discuss it with your attorney or your attorneys to decide whether you can be in business or not. Physical hazard is like what? Icy roads, we got it tonight. Physical hazard, you're gonna drive away from here, it's gonna be dark, you hope there's no ice there, that'd be a physical hazard. Diversifiable risk, we talked about that, I can't imagine you remember that. Diversifiable risk affects who? The entire economy?
Individuals, small groups.
Very good, better than I thought. Okay, individuals or small groups. No single definition of insurance. Pooling of risk. Pooling of risk is spreading out the losses. There's a term for it. Pooling of losses has been, or pooling of risk has been called the what? Of
Heart
insurance.
Heart of insurance.
The heart of insurance. Okay, if you were here last Wednesday, you've now heard some things twice, and you've heard everything at least once. So, any questions, anything come to mind? We can talk about a whole bunch of stuff that's not on the test, but I don't see any point in that. Okay, if you think of anything, email me. If you're not going to be here Wednesday, that I need to know. need to make arrangements?
We're supposed to have a baseball game tomorrow, but that's not gonna happen, so there's a chance we have to play Adam Foria State, so I'll email you and let you know as soon as I know.
Okay. We'll have to make arrangements.
I might be free.
Okay. And that's a good thing. This isn't, generally, this isn't a